Starting off with financial instruments. Now let's just do an overall introduction, and what I want you to see is that there's a definition for a financial instrument as well as later on for a financial asset and a financial liability. Let's start off defining a financial instrument. Well, it's any contract, remember there has to be a contract, right, that gives rise to a financial asset of one entity and a financial liability or equity instrument of another. So this is a zero-sum game always. There's a asset and a liability / equity on the one side. Okay, yeah, there's some difficulties about classification, mainly with preference shares, but we'll get there a little bit later. For now, I just need you to learn these definitions. The first thing you need to do when you get a financial instrument that comes across your table, you need to either decide whether it's a financial asset or a financial liability. Remember, it will be a financial asset if you are the purchaser, right? If you are the purchaser or holder and you are going to receive future economic benefits. Okay, then you're dealing with a financial asset. If it's a financial liability, you are generally the issuer, right? And there will be future outflows. You must look at the question or the situation and decide. Remember, you might also have issued equity, but for now we're just going to assume liabilities or assets. Okay, so let's go and define a financial asset. A financial asset is cash or a contractual right to receive cash, such as trade receivables or debtors, or any equity instrument of another entity. Not your shares, but you've gone and purchased another company's shares as an investment. Or there could be a derivative instrument, such as a forward exchange contract, an options contract, a future or a forward contract. But here, you will have to have a favorable balance towards the entity. Okay, because derivatives are a zero-sum game. Either you're a winner or a loser. If you're a winner, then it's a financial asset. Great, some examples of financial assets: investments in listed shares, investments in unlisted shares. Those are equity instruments of another entity that you've gone and purchased. Investments in listed bonds. Here you will be, what guys? Receiving the interest, right? And later on receiving the capital back. You might have a loan receivable. This includes employee loans, etc. and your debtors, trade and other receivables. You might also have option contracts or futures contracts, which are both derivative instruments, but they'll only be assets if there is a favorable balance. You are getting the future benefits. You're in the winner side of the equation. Okay. Financial liabilities includes a contractual obligation to deliver cash or another financial asset, a contract settled in the entity's own equity instruments, i.e. you will have to issue shares, okay, but it'll be a variable number of shares and a fixed rand value. So here, you'll come across this repeatedly. If the contract says you have to issue shares to the tune of 10 million, okay, 10 million currency units, whether it's rands, dollars, whatever. If you're issuing a variable number of shares, so it doesn't matter what the share price is, you will issue the number of shares that will equal $10 million or 10 million rand. Fixed rand value means I have a liability. If it was the other way around and I had to issue 2,000 shares and the contract didn't mention the number of rand or dollars, the fixed value, so fixed number of shares, variable number of rands, well then it's going to be equity, not a liability, right? But you'll deal with that in more complex aspects in courses. Then it might be a derivative instrument which is unfavorable to the entity, i.e. you're the loser, right? Now I just want you to understand there's one more thing here, and I haven't put it into the notes, but what do we do with equity? Let's go and insert a page quickly. So remember, equity equals assets minus liabilities. So we call this we've defined the asset, we've defined the financial liability. For it to be an equity instrument, it must be the residual interest. Okay, and we're going to deal with that in later, more advanced courses on compound instruments, etc. But for now, I need you to know the financial assets definition, the financial liability definition, and know that equity equals assets minus liabilities. Quickly jumping back for liabilities, just quickly listing some basic examples. We might have a loan payable to the bank, interest-bearing borrowings. Trade and other payables, creditors, right? A finance lease liability. Remember, there's another standard on that for some of the recognition and measurement issues in IAS 17. You might issue a bond onto the listed exchange, right? So here you are issuing a bond instead of buying a bond. It's a liability. You might have derivatives like options or futures, but they have unfavorable balances towards you. Okay, so introduction done. We're getting a feel for where we're at. Let's move on to a bit more of the detail. Thank you.